Welcome to Far From Wall Street. This is Michael McCall for Monday, December 18th. Welcome back. 2017 was a very eventful year. Here's a look back at the big stories of 2017 that affected your wealth. The year began with a major move. President Donald Trump's move to the White House. Republicans also came into control of both chambers of the U.S. Congress. Hopes were high for tax reform, even before President Trump was sworn into office as the 45th President of the United States on January 20th. The Standard & Poor's 500 hit its first record high of 2017 on January 6th, and by the end of the month, the Dow Jones Industrial Average topped 20,000 for the first time ever. In February, Mr. Trump's economic policies were big news for stocks. A major ratings agency warned that Trump administration policies posed a risk to international economic conditions. However, the promise of tax reform and a stream of positive economic reports pushed stock prices to new record highs. The 12-month results were in on the investment predictions made by the biggest names on Wall Street. If you followed the advice given in 2016 by the group dubbed by barons as the Billionaire Bears, your results at the end of 2017 were a disaster. In March, Janet Yellen, chair of the Federal Reserve, said the Fed's mission of promoting full employment while keeping inflation low had been accomplished. Interest rates in the economy were fully recovered from the 2008 recession. A rise in rates was expected. Later that month, Mr. Trump suffered a setback when Republicans in Congress could not agree on legislation to repeal and replace Obamacare. And yet, the first quarter of 2017 ended with stocks posting a 6.1% total return. In April, economists were busy hunting for the correct forecast for the rate of growth in the U.S. economy. Their estimates were all over the place. The actual first quarter growth rate later came in at just 0.7%. That didn't bother investors, though. They were already looking ahead to the rest of 2017 with expectations for much stronger growth. On May 4th, President Trump heralded a legislative win in the White House Rose Garden after the House of Representatives passed a bill to repeal and replace Obamacare. Later in the month, the Justice Department appointed a special counsel to investigate ties between President Trump's campaign and Russia. The political scandal did not distract investors who bid stock prices to record highs as monthly economic data kept strengthening. In June, real wages were soaring and job numbers were strong in June, even as financial media outlets, including CNBC, Barron's, and the Wall Street Journal, perpetuated myths that job numbers were weak and real wages were stagnant. Chuck Todd, NBC chief political reporter, even told a national audience on Meet the Press that jobs were disappearing in a misleading 2-minute segment packed with inaccuracies. Also in June, the Fed made history by beginning a new phase in its monetary policy, slowly unwinding Treasury bond purchases the government had made to stimulate business activity after the Great Recession. The S&P 500 returned 2.9% in the second quarter and an astounding 9.2% in the first half of 2017. In July, we tallied the performance of sector picks by Wall Street giants, and it was an almost comical reckoning. The returns on sector picks of Wall Street's top strategists showed no correlation to reality. Compared with the actual returns on the S&P 500 10 industry sectors, the performance of the picks by Wall Street's top strategists appeared to be about as random as a monkey throwing darts. Another reminder why it's great to be far from Wall Street. In August, one of the billionaire bears resurfaced, this time with a frightening forecast. Do you remember this, Jewel? The market would drop between August and November. Again, he was wrong. Despite problems in Washington and tension with North Korea, the S&P 500 kept rising. That same month, the IMF issued one of the brightest forecasts in years for world economic growth. Then, Hurricane Harvey hit Texas, leaving a trail of 77 deaths and nearly $200 billion of destruction. The markets were not deterred. In rapid succession, Hurricane Irma slammed Florida and Hurricane Maria traversed the entire length of Puerto Rico, capping one of the worst hurricane seasons since records were first kept over a century ago. The financial press continued to be distracted from the biggest economic story of the year. Real wages were accelerating. Yet CNN and the New York Times were still reporting wage growth was sluggish. The Trump administration and Republican congressional leadership agreed on a 2018 budget and a framework for a $1.5 to $2 trillion tax cut. Despite the terrible hurricanes in the Atlantic, the nuclear threat from North Korea, and the political storms swirling in Washington, the S&P 500 continued its string of record-breaking highs. In October, the Brookings Institution released a study showing that real wage growth was soaring. Compared with the 10-year expansion spanning the 1990s and the last expansion from 2000 to 2006, real wages were soaring, and the pace was accelerating as the third quarter closed. The echo chamber, resounding so clearly in the national political media, was also reflected in the national financial media, which remained oblivious to the fact that Americans were in the best financial shape in generations. The market knew it, and the S&P 500 continued in its record-breaking run, boosting diversified portfolios. Stocks had nearly doubled in price in the previous 5 years, and major indicators were brightening. After the government special prosecutor indicted Trump's one-time campaign manager and a former foreign policy advisor entered a guilty plea to lying to the FBI, political uncertainties loomed larger. Tax reform hurtled towards passage in November, and President Trump nominated Jerome Powell to chair the Federal Reserve, replacing Janet Yellen. Despite dramatic headlines and the pace of major breaking stories flashing across TV news channels, leading economic indicators were signaling that a strong holiday season was ahead, and the likelihood of a broad economic surge boosted stocks again. As December began, the president's former head of the National Security Agency, Michael Flynn, pled guilty to lying to the FBI about his contacts with Russia, and a dark cloud hung over the White House. Meanwhile, the new tax law was actually happening, and an earnings bump of 8% was expected. Since earnings ultimately drive stock prices, the earnings bumps signal that the 8.5-year economic expansion and bull market could carry on for the foreseeable future. But the new tax law created urgency for action to be taken on a range of tax-saving opportunities likely to be eliminated January 1st, 2018. Suddenly, a red-hot economy stimulated further by the tax bill was threatening to abruptly end the long run of good news. Despite unpredictable political circumstances and a constant concern in the press that a correction could be round the corner, 2017 showcased the strength of the U.S. economy, and stocks have risen steadily throughout the year, hitting record highs multiple times along the way. We are now 102 months into this expansion, and it could continue still. We wish you a Merry Christmas and a prosperous 2018. Please contact my office with any questions or to set up a meeting, and don't hesitate to share this video with friends who might benefit from my work. Remember, it's great to be far from Wall Street.